Hi, I'm John Hageman. Welcome to KNN. Today I'm here with Bob Knakal, and today we're going to talk about the 2022 year-end investment sales numbers in New York City. So Bob, we're filming a week before the end of the year. We have seen quite a wild ride through 2022. Tell us what we saw through the year so far.
Hags, it was a wild ride, to say the least, and we don't have our year-end numbers yet. We have a sense of where the market's headed, but I think if we look back on 2022, it was a transitional year in the market. Clearly, looking at cyclicality, 2020 was the low point in the market, given COVID and everything that happened. We had a very nice rebound in 2021, up significantly from where we were in 2020, still not near where we were at the peak back in 2015, but a nice increase in activity in 2021. And 2022 comes along, and everything was rolling along really, really nicely until interest rates started impacting the financing market and completely changed everything that we've been going through. So to say it was a wild ride is an understatement. Really, nice. Really crazy stuff.
So Bob, with that being said, why don't you give us some of the historical numbers as we normally do to kind of put in perspective of what we saw in 2022.
Right. And again, we're talking about investment sales over 10 million in Manhattan as a proxy for the broader market. Peak of the market, clearly 2015, 57.4 billion in sales volume. That was an all-time record. Dropped to 11.1 billion in 2020, the low point. Got up to 15.7 billion in 2021, and through the first 3 quarters of this year, it was tracking to be about 21.7 billion, which would have been a 38% increase. However, we know that the fourth quarter numbers are going to be down very significantly, and if we end up ahead by 10 or 20 from 2021, I think that'll be a good outcome for the market. But it's TBD. We have to see. We need another 3-4 weeks from today before we really know what the year-end numbers look like. But really what shifted the market, Hags, was the fact that the Fed's policy on interest rates finally started to creep into the market.
Bob, why don't you give a little more color on what you mean by that? You're saying finally crept into the market.
Yeah, well, the Fed started increasing interest rates in March, but it really wasn't until late September, early October when lenders started passing along those increases in rates to borrowers. And really, the whole market became different at that point in time. We're telling clients today, as you know, that any sales that happened more than 3.5 months ago really are irrelevant, and any sales that closed recently where the contracts were signed more than 3.5 months ago are really not indicative of the current market. So I think if you look at the way the market is today, there is a huge correlation between what's happening in the debt markets and what's happening in the sale market. There's dysfunction in the debt market. That dysfunction is leading to downward pressure being exerted on values. It's created a stagnation almost in the market, so we're going to see the volume of sales down significantly. We talked about the dollar volume of sales. If we look at number of properties sold, we went from 484 sales in 2015 just to 109 in 2020. We were 191 last year. We're tracking towards 215 this year. But again, we'll be lucky if we come out with the same total this year as last year based on the reduction we're going to see in the fourth quarter. But so much of what we are experiencing now is a function of what's happening in the debt markets and how that's impacting sales.
Bob, you mentioned the increase in interest rates, and one thing that a lot of our clients and buyers are talking about is how that translates to and affects cap rates. Give us some color on what we've seen, in real-time transactions.
Right, and Hags, I think when you talk about lending rates and cap rates, they're kind of related, but they're not highly correlated. If you look back on our old Knakal study, for instance, tracks lending rates versus cap rates going all the way back to 1984, we see that differences in change of direction of interest rates impacts the direction of cap rates, but not the magnitude of cap rates. So there is not really a very tight correlation between movements in interest rates and movement in cap rates. The movement in cap rates, or the magnitude of movement in cap rate, is really much more dependent on the flow of capital. And the flow of capital is dependent on that battle between fear and greed that exists in every market. As we sit here now in December of 2022, fear is winning that battle. And so a lot of capital is on the sideline. A lot of lenders are making quotes on deals that we think they hope not to win. And, a lender can't say they're out of the market, so they're just making very, very aggressive quotes, hoping they don't get those loans to make. But the correlation between movement in cap rates, or the magnitude of cap rates, really is more dependent on capital flows. And capital flows tend to move with a herd mentality, and so far the herd's not moving. So it's going to be very interesting to see how that plays out next year.
So given where we are as it is today and what we saw in the last 6 months, what do you think 2023 looks like, and particularly, with the first quarter as we go into it?
Yeah, I think the first quarter and then the second quarter, really the first half of next year, is going to be a challenge, because what the Fed is telegraphing, at least so far, is that rates will continue to go up. Maybe not at the same pace that they've gone up. Maybe they max out sometime in the first half of next year. But I think that will lead to this continued activity that we've seen. The slowness of activity in the fourth quarter is going to leak into the beginning of next year as well. But I hope that we're going to see, and I expect we're going to see, a big increase in the volume of sales in the second half of the year, which is going to be precipitated by the fact that folks are not going to be able to refinance. And that's a topic we're going to get into in our next episode. But I do expect that the volume of sales will be up in the second half of next year. First half is going to be a little bit of tough sledding. We're really looking for motivation of sellers today, and want to work for people who are highly motivated to sell, because if you're not highly motivated, unlikely you're going to sell. But I think there, fortunately, is still a decent level of demand in the market. It's just at a different price threshold, but demand seems to be pretty good. We're seeing more high net worth individuals and families that are very, very active, from both in New York and around the country, that are coming to New York to look at transactions. Institutional capital, not quite as robust, but it's going to be a very, very interesting year in 2023, no doubt.